Welcome to Survive and Thrive. There's a practical question that all investors tend to grapple with. It's one that comes up a lot in our conversations with members of the Oxford Club. And that is how to know what to buy and how much of it to buy. In other words, how do I allocate the funds I have available to invest? So today, that's what I'll cover. How to allocate your investment capital, where to get started if you haven't, and what to do once you're fully invested if you are. Whether you have 10,000, 100,000, or $1 million, we all have decisions to make about how much to invest and what to do when we're fully invested. So let's start with a basic premise, which is one of our pillars of wealth, having to do with risk reduction and diversification, and that is this. At the Oxford Club, we believe that you want no more than 4% of your investment capital in any one position. So let's say that you start with 20,000. 4% would be roughly $800 per position. If you started with 200,000, 4% would be $8,000 per position. When you combine that with another pillar of ours, which is always know your exit strategy, for most positions, you'll have a stop loss in place of around 25%. If you have no more than 4% in any trade and can only lose 25% of that at most, you've reduced your maximum loss all the way down to 1% on any position. Keep in mind, there may be stocks that trade at a price per share above your position size, going back to the 20K example and 800 per position, like Amazon would be more than that. And there may be certain stocks where you can only buy one or a few shares, depending on what you're starting with. But whether you own 1 share or 1,000 shares, if the position returns 20%, you make 20% return on the money you have invested. The number of shares doesn't change that, nor does the price for that matter per share. And we invest for a percentage return. We're looking for percentage returns. So that's the basic premise. No more than 4% per position based on whatever you're starting with. And frankly, look at what you have from the past too through that same lens. What percentage of your portfolio does it represent? As you look at our various research, some is longer term and lower risk, and some is shorter term and higher risk, but faster potential return. Now, we have tools and newer versions of tools coming out soon that can help you decide how much to put in the longer term portfolios and how much in the shorter term. But once you decide which editor or which services you're going to follow, which frankly, you should determine based on what makes the most sense to you personally, you can begin buying open positions that are listed as a buy, and where it's relevant, the newer recommendations are the newest. Some portfolios have been around a while and don't change that much, like Alex Green's Gone Fishing portfolio. But for others, they change more frequently and are replenished with new trades more often. What happens when you are fully invested though, and there are new recommendations coming out that you'd like to invest in? First of all, this is a good problem to have. For the most part, this means your positions are doing well, haven't been stopped out, and have room to run. And the value of your cash isn't being eaten alive by inflation or devaluation. But in this situation, you really have two choices. Actually, three choices. Number one, add more cash to your investment portfolio, which means if you only self-directed a portion of your assets at first or currently, you may consider self-directing more. Or you can regularly add more cash to your account if you have a source of income, or you could go out and create a source of income. If you're working, you can automatically distribute some of your income to your brokerage account. And I do this regularly, personally. Number two, you can wait. As mentioned before, each Oxford Club recommendation has an exit strategy. There will be positions that rise, are sold, or stop out, having gone up or down, that will free up cash to put back to work in something new. And number three, you always have the option to sell portions of a position after you hit a certain gain amount. Often the analysts at the club will instruct you to do this anyway. They may suggest you sell half your position after a rise of 100% and more as the position continues to rise. But you can decide for yourself what's a good level to take profits off the table. Now, we generally suggest letting winners run. But sometimes, as I've mentioned in past videos, we end up holding on to something for the wrong reasons. Maybe we didn't follow a previous stop loss, and it's time to cut our losses and move on. All right, so just to review a couple of these ideas. Start with position sizing. We suggest no more than 4% in any position. You can certainly decide what works best for you, but pick a number and stick with it. Be consistent. And remember, we invest for percentage returns, and they are the same no matter how many shares you own. 20% return on $1,000 is 20% no matter how many shares you own. Decide how much you want to invest in long-term lower risk versus short-term higher risk but faster potential return. Then start buying anything listed as a buy, starting with the most recent recommendations, and keep going until you're fully invested. Once you are fully invested, you have three choices. You can add more cash through income or from savings. You can wait until something is naturally sold through profit taking or stop losses. Or you can sell a portion of an open position if it's gone up to a level you're happy with, or to cut your losses because you're holding on to something for the wrong reasons. Lastly, shoot me a note and let me know if this all makes sense to you, or share feedback you have or questions about how helpful this topic is and what else you'd like to understand better. Until next time, I'm Nathan Hurd, and this has been Survive and Thrive. Thank you.